So welcome back to our last session of Research in Options Rio 2020. It's really a special moment. It's a big pleasure to get to this ending of this meeting, which was extremely successful. Let me remind everyone that we had 800 registered participants, and we had an average of about 60 to 70 attendance, people in the attendance. So this is extremely good. So I'm very glad to get to this point. I'm very glad to honor our dear friend Marco Avejaneda in this moment. And I'd like to mention that this was a joint project of organization with the help of with this IMPA and Khalifa University. And I'd like also to mention that this is also supported by Diamond Investments. And we hope that next year we will continue again with the series of meetings researching options. So it's really my greatest pleasure to introduce our next speaker, who is going to be Professor Matheus Grasselli from McMaster University. Um, Matheus is a long-standing participant of Research in Options. I think he participated in most of the meetings, and if not all of the meetings from a certain point on. And he's going to tell us a lot today about monetary policy responses to COVID-19, a comparison with the 2008 crisis and implications for the future of central banking. Matheus, thank you so much for your continued support and for being here today telling us about this important subject.
Thank you, Jorge. And I should say, I participated in all of the research and options, and also the one that was before that was not called research and options. So I was there for everything, and this is a very bizarre year because of that. So it's the in 14 years I've been going to Brazil exactly at this time of the year. I've never been in Canada for this week, the first week of December, and then every day I woke up this week and thought, oh, this is what Canada looks like now. So it's all very strange for all sorts of reasons this year. But thank you very much for the invitation. It's great to participate again, and happy birthday to Marco, and happy birthday to Bruno also around this time of the year. So yes, it's going to be yet another talk about COVID, but it's COVID related to central banking. So the history of this paper is that around March, when COVID really hit the world at large, I was working on a paper for the future of central banking as an outcome of a conference that I had participated last year. And the focus of the paper was central banking and climate change, so green monetary policy and green quantitative easing and issues of the sort. So I was paying attention to the actions of central bankers. And then the crisis, the COVID crisis hit, and I became obsessed with reading every day practically the press releases of the Federal Reserve in the United States, and quickly realized that there was something major going on, and then started collecting data about that and refocus the paper on the monetary response to COVID, and then put climate change for another paper. So for now, the focus of my research is the future of central banking, but in relation to what they did immediately after the COVID crisis and continue to do. So why did central banks think that they had to intervene? After all, this is a public health crisis, not immediately obvious that there would be a role for a central bank. Well, because if you just look at the signals for stress in financial markets, and many of the figures in this paper are going to be direct comparisons between 2008 with what just happened at COVID. So there will be time series that go back from earlier in 2006 and 7 and then continue to the most recent data that I got was for November last month. So you can see here two things. You can see the TED spread, so general measure of credit risk in the market is the spread from LIBOR to government bonds. And you can see the VIX that many participants already talked about in this meeting, which gives a sense of volatility in financial markets. And both, in particular the VIX, were showing levels that were comparable to the 2008 level. So that put central banks in high alert, and the turbulence in financial markets that it was implied in the VIX did come. So this is what was happening then with two indices, so the Dow Jones average and the S&P 500. And again, so you can just look at the drop around March and compare that with the drop that happened in 2008. So it took about 6 weeks around March for a cumulative drop of about 35%, and comparatively that happened in 2008 over 6 months. So everything was moving at a much higher speed, and the reaction of the central banks was also much faster. So I'm going to trace now in the next couple of slides what central banks did from more conventional to more unconventional monetary policies, and compare that with what they did in 2008. So the first thing that a central bank does if they see that the market conditions are deteriorating is to try to provide liquidity, to try to relax the payment constraint of many of the participants by making it easier to borrow. And easier to borrow means that the cost of borrowing goes down, means that interest rates go down. So these are the trajectory of the policy rates for major central banks around the world. And you can see there what's going on with the Fed funds rate, as perhaps the most advertised one is the blue line. And again, you can see that in 2 weeks in 2020, it dropped by 150 basis points versus the time that it took in 2008. It took 9 months for a comparable cut of about 225 basis points. And for other central banks, the story is the same. Those that had room to cut interest rates at the start of 2020 did that. Here you can see the Bank of Canada as well as the Fed. And those who had maintained their policy rates low, primarily in the European Union and the Bank of Japan, that were already around zero, hovering around zero. What they did was just to continue a zero interest rate policy. So that poses a problem, because it could be that the market deteriorates even further. So what do you do if not even at very low rates, it's enough for people to satisfy their financial constraints and their financial commitments? So you move into the territory of emergency lending. So that's the traditional role of a central bank that's been going on since the 18th century, with the creation of the Bank of England, that it should lend freely at high rates and with good collateral. So this is the idea of a discount window, otherwise known as the lender of last resort. And so here you can see two facilities. So in 2008, this was done. So primary credit at the Fed is how the Fed calls its discount window. It's what is available to major financial institutions that then just borrow at the advertised rate and have some time to repay it. That was done in 2008, but it was not enough because there's a stigma to accessing this discount window. Nobody wants to be the first institution that has to go and borrow from the Fed in time of need. So instead, the clever idea that the Fed had back then was to create a reverse mechanism, where instead of waiting for the institutions to come and ask, they offered in an auction. So this was the term auction credit facility, and that was incredibly popular. You can see this in this figure. It reached about $500 billion at some stage in early 2009. So emergency lending did occur in 2020, but was not as pronounced. But it was of the order comparable to what happened with the traditional primary credit facility in 2008. But that's not the only type of lending. So then there is more emergency lending. So emergency lending that goes beyond what is the traditional role of the Fed. And in the United States, this is done under this fabled paragraph of the Federal Reserve Act called Section 13, Paragraph 3, that says that under exigent circumstances, the Fed can lend to other types of financial institutions, basically, or not even financial. It can lend to any institution in the country as long as they demonstrate the extraordinary circumstances and there is authorization from the Treasury. So this is where the whole alphabet soup of facilities, you have the primary dealer credit facilities, the TALF, and then mutual market money market mutual fund facilities. And but without going into detail of all of them, suffice it to say that they all have the same characteristic, which is provide lending, so lend in terms of reserves from the Fed, to participant institutions that might not necessarily be banks. And with that lending, those institutions go and buy other securities in the market. So it's not the Fed directly buying those securities, but it's providing a lending mechanism, so with very favorable terms, so that they can go and buy, for example, commercial paper and the securities that are normally held by money market mutual funds. So this was also very popular in the previous crisis, and immediately in 2020 they all came back. The Fed gave a press release after press release saying that all of them were available to institutions that needed to access them. Now, this one is also a type of emergency lending, but it's emergency lending between central banks, because it was quickly realized in 2008 that many international financial institutions, they had liabilities in US dollars that they couldn't meet just by borrowing from their own central banks in the local currency. So it was necessary to establish swap currency lines between central banks, so that, for example, the European Central Bank could swap euros by dollars and then lend dollars to European banks. So in this way, it's still lender of last resort, but it's a much larger scope. It's lender of last resort for the entire world, so to speak. A very interesting thing happened in 2020. You can see here, this is the only one that gets to comparable magnitude as in 2008. They expanded the club of central banks that had access to these liquidity swaps. In 2008, it only consisted of very select 6 central banks around the world. In 2020, they expanded by adding 9 more, including the Central Bank of Brazil, Mexico, and other places. But this, you might think that is still within the mandate of traditional mandate of a central bank of providing liquidity to financial institutions that can go on and operate in their normal businesses. Then we moved to more uncharted territory in 2008 with what Perry Merlin and others call a dealer of last resort. So this is not the Fed providing lending facilities so that an institution will go and operate in the market, but it's the Fed directly supporting the market by expanding its own balance sheet and buying, for example, commercial paper, or in the case here shown in the picture, Maiden Lane was the creative name that they came up with for the facility that purchased assets from Lehman Brothers and starting Bear Stearns, and then Lehman, and then other toxic assets in the 2008 crisis. So this also came back in 2020, and with an even expanded role of this, what is called the corporate credit facility. And this is the Fed directly purchasing bonds bonds from corporations. And so these are traded securities still, but they are traded securities that are not securitized. They are direct individual bonds from corporations. So this was a step that in 2008 they thought was impossible, and they created in 2020. And even further, the Main Street Lending Facility is a program where the Fed purchased loans from corporations that are not big enough to issue bonds in the market. So these are now non-traded securities, and they go directly from a bank and they purchase those loans from the bank. So this is just one step removed from the Fed directly lending to those corporations in the economy at large. So this starts to look like what many people call quantitative easing. Now, quantitative easing is actually more confined than what I just described. It consists of also asset purchasing, but asset purchasing of specific classes, so treasury securities primarily, and mortgage-based securities. But it has the objective of supporting those markets. So it's a market intervention, if you like. It's not liquidity for financial institutions. It's market operation. And you can see there the inflection points in the Fed balance sheet that, in 2008, it more or less doubled in size from 1 trillion to about 2 trillion and continued to expand. And then in 2020, it went from about 4 trillion to over 6 trillion, so close to 7 trillion. US dollars. And if you think that this, so this is just for the securities, this is the entire balance sheet of the Fed that includes both the securities and the lending programs that I just mentioned before. Now, if you think that this is something that it's only at the Fed, that's not what happened. Part of the paper is to explore what other central banks did. So if you look at the Bank of England, the ECB, the Bank of Japan, and the Bank of Canada, they all went in the same direction. They executed programs that were very similar from the Fed, and they all had this expansionary effect. And now I'm switching to the second half of the talk, which is why is it that they thought that they had to go directly in the markets very quickly? So not just doing, this idea of dealer of last resort that was kind of taboo in 2008. In 2020 was the first thing that they did. So it looks like it's not even a dealer of last resort, it's a dealer of first resort. So as soon as there's any turbulence in the market, the Federal Reserve comes in and uses its own balance sheet to take positions and stabilize the market. And why is that? So this is something that I like to call the illumination of shadow banking. So in 2008, there was much that was said about the role of shadow banking in the crisis, that the crisis was a traditional bank run, but instead of being a bank run on retail banks, it was a bank run on shadow banks. And what are shadow banks? So these are institutions that do what's called market-based finance. So again, Perry Merlin likes to describe this as securities market lending of money market borrowing. So this is institutions that do not operate like traditional banks where they have deposits on one side and loans on the other side, but rather have securitized instruments on both sides of their balance sheets. Well, that means that there's an over-reliance on how the markets operate, because you're going to be doing lending through markets. So it's market-based finance, and therefore the markets need to operate very smoothly. Why? Because the typical lending instrument in this is a repo, and a repo relies heavily in a complicated, very sophisticated mechanism of collateral valuation and haircuts that as soon as the securities on which it's based start to fluctuate more than they should, there's a very high likelihood of this market's freezing, and that that's how the lending stops, because most of the lending is done through these channels and not through traditional lending, and then it eventually hits the economy. So I end up with that line that, this requires broad-based central banking, so not just interventions on financial institutions that used to be just the domain of central banking, but markets for all kinds of assets, essentially anything that is used in this mechanism of market-based financing. So is this the only thing that we can do? So at this point, we should ask, where does it end if the Federal Reserve continues to expand, or if central banks continue to expand their role in the economy? And many people were asking those questions throughout 2020, and I thought that it was time to kind of bring back an idea that Alex Lipton and I have worked on as a response of the last financial crisis, which is that of narrow banking. So try to move in the opposite direction. So what is narrow banking? So this was proposed first by economists at the University of Chicago in the 1930s as a response to the crisis back then. And it includes many profound changes in banking, but the most important is 100% reserve banking. So that is to say, separate the payment system function that the banks satisfied, namely providing the payments from transactions from one client to another, from the lending function of the bank. So the payment system would be fully backed by reserves, and then the lending needs to be done by something else, and we're going to see in the next couple of slides how this can be done. So this was not implemented in the 1930s, but the idea never went away. And every time that there is a new financial crisis, it's kind of resurrected as a possibility. So what if the role of banking is reimagined in this way? So I ask here, is it time to revisit it? And so that's what I'm going to propose in the next 10 minutes. So what are the objections that are commonly raised against narrow banking? The first one is that this would not provide adequate credit. So it's the idea that if banks have to have reserves as assets for all of the deposits, then where they're going to raise the funds to fund their lending. So the loans are then the components of the assets that need to be matched with other types of liabilities. And the answer to that is, well, anything but deposits. And banks have other ways of raising funds. For example, they can have, and by the way, by deposits, I mean demand deposits. So these are the deposits that can be withdrawn at any time, which is what we call conventional demand deposits. So they can raise funds, for example, with time deposits, so that you put savings accounts that have you can only withdraw at certain times, or they can raise funds by issuing bonds, so there are banks that do issue bonds, or more generally, they can raise with equity. So this it's exactly what money market mutual funds do. They look like banks because you buy shares in the money market mutual funds, and those shares, they look like you can withdraw them at any time. So they have the look and feel of a deposit, but they are not a deposit. They are equity. And there's no reason why other banks cannot be funded like that, with a much larger equity proportion than a deposits proportion. The other objection is that nobody knows how the macroeconomy is going to react to this. And when there was a referendum in Switzerland to inquire on the viability of narrow banking, that was the reason most people gave for not wanting to do it. It's like it's too novel. And the other one is operational difficulties. So if the Fed is going to have reserves of the scale of all of the deposit base in the economy, then this becomes just an operational complex system to manage. Now, on the operational difficulties, recent advances in cryptocurrencies indicate that this can be done at the scale of that is necessary for narrow banking, and this goes under the name of central bank digital currencies, and that's some work that Alex Lipton and I are also investigating, but not for this paper. So what I want to do in the next 5 minutes or so is just to address the objection of lack of adequate credit, and also the effects on the macroeconomy. Because if there's something that has never been done before, then you cannot rely on data to see what the effect is. You need to have a model. So that's why we're here for. I firmly believe that mathematicians and modelers in general should respond to that kind of call, precisely by showing a model that would indicate what happens in something that has never been tried and tested. So here we go. So the type of model that I want to show would be familiar to people who have seen other presentations of mine. It's a macroeconomic model. Here's the notation that I'm going to employ. There's a lot of letters in there, but I'm going to be repeating that if necessary. But the important thing is that, none of the ingredients of the model is too strange. There's a common economic concepts: production, and then the capital to output, employment rates, and so on and so forth. What is then somewhat novel is how to put these ingredients together, and this goes under this methodology of a stock flow consistent model. So when I gave a similar talk like this last month in Princeton and put this slide up, René Carmona said that this is what he calls an eye test. So yes, it's an eye test because there are many symbols in there, but you don't need to read all of the symbols, but you need to understand that it's a complete model of how different sectors of the economy relate to each other based on the transactions between sectors. And then it's a model that it's called stock flow consistent because the transactions are what drive then the adjustments in the stocks, which are the balance sheet items for the different sectors of the economy. So you can look there, for example, consumption is something that households pay to firms, whereas wages are things that firms pay to households. And then at the end of each column, you have the financial balances of those sectors, and those financial balances need to be redistributed into balance sheet items. The important thing here is the addition of the government sector, which is split from the central bank, and it interacts with the economy through three channels here. So it's fiscal spending, taxation, and I'm not going to say much about either of those, but then it's the monetary policy here, which has to do with buying assets from the banks, and in return of buying assets from the banks, increasing the amount of reserves that the banks have. So this is what I just said. You can impose a reserve requirement on the bank and say that they need to maintain a fraction of their deposits as reserves in the central bank. And in addition, you can put some capital requirements. So here is just a fraction. So say that the equity of the bank, which I'm denoting by X here, needs to be a fraction of their assets. But you can also have risk-weighted assets and say that central bank reserves have zero risk, and also theta here indicates government bills that also they have zero risk, government securities. So the only risk is for loans or other securities, and then that's the reserve capital requirement there. Very well. Then what I said about fiscal policies, that there's some spending that the government does and there's some taxation, but I'm going to assume for the purpose of this topic that those are just fixed proportions of GDP. So it's not the type of stimulus spending that you might do. So I'm not saying that I'm against that, just saying that I want to concentrate on the strict monetary side and the interaction of the central bank with the banking sector. And that's done through at the last step there that just says that the central bank conducts monetary policy by purchasing bills. So this is the amount of bills that the central bank holds, theta, in the same amount as cash that then they provide to households and reserves that they provide to the banks. And so you can work the mathematics of the model and convince yourself that it reduces to a four-dimensional dynamical system, here four-dimensional system of ODEs, where the first three variables would be familiar to people following, for example, the Keene model. This would be the wage share, the employment, and the loan ratio for firms. And the last variable is the deposit ratio of the firms, because now we are dealing with reserves that need to be a fraction of the deposit. So it's important to keep that as a state variable of the model as well. And then there are some auxiliary variables that can be determined from those, in particular the ones that I'm showing in this graph. So the last thing that I want to do here, if George allows me, is just to show a couple of simulations of this model. The first one is, so what I call fractional banking is just by saying that is what we currently do. So the reserve requirement is, say, 10% of deposits, and there is an equilibrium of the model where all of the ratios go to finite values, and this would be a good and stable macroeconomic outcome. But there's another equilibrium of the model that is also stable but not so good, where the ratios kind of diverge after a certain time, and the things that are going up to plus infinity in the right graph in there are things like the debt ratio of the private sector, and then GDP, which is the important thing you want to keep track here, is this green line in the first graph that first expands and then goes on contracting. So that's a situation you want to avoid, but it's one of the possible equilibria in the model. Now, with full reserve banking, which is the case that I want to emphasize, so you just say that the banks need to have reserves in the amount of their demand deposits. I just explained here how they would separate and how they would be financing their lending with liabilities that correspond to time deposits. So with that, you can simulate the model again and then see that it also has a finite equilibrium with a growing economy. So it doesn't necessarily contract the economy just by being full reserve. So you can have investment and you can have technology and the economy continue to grow. And it also has the undesirable equilibrium. However, the undesirable equilibrium, the two things you should see in this graph is that it occurs much earlier, so you can monitor it. It doesn't take that long to accumulate that and then be in a situation that it's somewhat irreversible. But crucially, the signature of this equilibrium in this case is that you have negative government debt. Now, negative government debt means that the government is lending to banks in order to satisfy their reserve requirement. And that's exactly the type of thing that the government can then put a stop to. It's very difficult for a government to stop borrowing if they need to maintain a certain level of spending, but it's very easy for a government to stop lending. So it can have a much more effective monitoring just by not lending to the banking system. It's a more binding type of constraint that it puts on the banking system. And then I'm ending here, and so these are the conclusions. And the one final slide that I want to show is just to the last point that I have there. If not now, when? And that's because, the other thing that people say that narrow banking would never work and could never be implemented is to say, but where are we going to find all the reserves? If you need to have reserves that are at the same level of deposits, this can never work, because by definition, the bank has much more deposits than reserves. And then if you just look at commercial banks in the United States since 2008, so the red line is the crucial one, is the amount of deposits. And yes, before 2008, the required reserves and also excess reserves, they were a tiny fraction of deposits. So if anybody came in 2004 and said, let's do narrow banking right now, you would have to raise $400 billion in reserves. That would be an operational, gigantic task. But then just because of the monetary policy interventions that the central banks did after 2008, reserves have actually been higher than deposits all along. They started to go below deposits in 2019, but COVID changed that dramatically. And now there's much more, all the banks are flush with reserves. So if there was any time where you would like to suggest the implementation of narrow banking, this should be an ideal time. And I will stop here. Thank you very much.
Thank you very much, Matheus. We already have questions popping up and discussions on the chat. So, of course, the usual suspects. So, Rafael Duadi is asking, do you think that if the COVID crisis didn't occur, the private debt bubble would have blown up?
Uh,
Wait. He
okay.
continues with his question, of course. So, in some sense, the COVID gave the Fed the opportunity to save the economy from a major crisis.
So, of course, we cannot predict that it would have blown up or not. But what we can say is that the conditions are there for the Fed to have to intervene anytime that there is some disturbance in markets that were before considered to be far away from the realm of what the Fed had to do. So what I think is that the fact that shadow banking now is a way of life, and they are not even calling it shadow banking anymore. They just call it non-banking financial intermediaries in an effort to say that this is fine, this is okay, this is just how the economy operates. It necessitates constant interventions from the Fed as soon as there is any sort of turbulence. And the turbulence could be because of COVID, or it could be because of some issues in the debt in the private market, as Rafael is saying. But the response of the central bank has to be the same, and it has to be direct purchasing of assets to support the price of the assets and to reduce the volatility. So volatility in assets became unacceptable because of the over-reliance on market-based finance. So yes, COVID might not have given a cover, but it was just an example of the type of intervention that if we continue in this path, the Fed will have to be doing more and more.
Okay, another question, perhaps the last question for Matheus, since we are running short of time. In fact, we are borrowing time now. So, Matheus, from Max de Souza, what would be the implications of narrow banking for banks?
Right. So the implication is that the traditional mix-up between these two functions, the payment system and the lending that the bank does, is cut. So they don't have the excuse that if they do bad lending, the Federal Reserve needs to save them, because then otherwise the depositors are going to suffer. So you see what I mean? It's like there has always been this thing that Epstein calls the banking club, using the word club to mean both a small group of people, but also the club that you go and club people in the head with, which is the banks need to lend. And sometimes the lending goes badly, and at that point they need to be saved, because otherwise the depositors suffer. But that's only if the two things that are essentially different, one is providing a social function of payment between depositors, and the other is providing lending, are intrinsically connected through the mechanism of endogenous money creation. So narrow banking severs that link, and it means that would be the situation where banks would just lose equity if they do excessive lending and excessive risk taking. But then everybody knows that investing in equity is risky. It's not a deposit. You're not losing your deposit.
Yes.
So I think that's a more streamlined way of operating.
Okay, very good, Matheus. Thank you so much again. It was very, very interesting, and thank you for all this.